Hello and welcome to the Daily Finance Wrap. And of course, happy Diwali to all our viewers. This is your daily dose of personal finance updates covering investments, insurance, real estate, and everything else about your money. We love to make this conversation and this show interactive, so please feel free to write in with your questions and queries, and we'd be more than happy to answer those with our experts. But first up, a quick check of the top headlines of the day. The markets ended the day in negative territory after locking in 2 days of gains. The Nifty closed below 24,350, while the Nifty was down 126 points. The overall market breadth wasn't too bad, and the broader markets outperformed the benchmark. Bank Nifty fell over 500 points, backed by financial stocks, while the Nifty, FMCG, and auto sectors were the gainers, thanks to optimistic festive demand. Top gainers on the street were Maruti and Marico. Well, the Dhanteras this time around wasn't as glorious as it has been in the past. India's gold market experienced a decline in demand yesterday, with sales dropping to 35 tons from last year's 42 tons, according to the India Bullion and Jewelers Association. However, surprisingly, while gold saw a dip in demand, it was silver's demand that rose substantially this time around. Well, the World Gold Council warned of a potential annual decrease in gold demand, predicting it could drop to between 700 and 750 tons in 2024, the lowest in 4 years on back of rising gold prices. Well, the Goods and Service Tax Network announced that starting early 2025, GST taxpayers will not be able to file monthly or annual returns 3 years after the original due date. This change will apply to all GST returns, including outward supply returns, liability payments, annual returns, and tax collected at source returns. In their advisory, GSTN encouraged taxpayers to review their records and submit any overdue returns to avoid complications in the future. GSTN emphasized that taxpayers should use the remaining time wisely to ensure all past GST dues are filed before the 3 year deadline takes effect. Well, it is Dhanteras and we're all in celebration mode, but the big question that most people land up asking is how is significant wealth created? Is it through direct equity or is it through a stable mutual fund portfolio? And to help us understand that, we have with us Srikanth Bhagavat, Managing Director and Principal Advisor at Hexagon Wealth. Thank you, Srikanth, for taking out the time to talk to us today. Srikanth, I'm sure you get asked this very often. Direct equity or mutual funds? What is better suited and for what type of an investor?
Good evening and wishing all of you a very, very happy Diwali. Okay. Yeah, it's a very common question that we receive, direct equity or mutual funds. If we were to consider the risk angle of it, then definitely mutual funds score above direct equity. They have a lower risk profile. Okay. It's only if you have the skill and knowledge and ability, then the direct equity part takes over. Otherwise, clearly it is mutual funds.
Right. We often hear about how somebody has invested in a multi-bagger and made non-linear returns over the longer period of time. You very rarely hear that you're anyone saying that about mutual funds. Is this just what we seem to hear and believe, or is this truly reality? Multi-baggers are only found and wealth is only created non-linear through direct equity.
So multi-bagger is one term and non-linear is another term. Okay, so let's look at both of them separately. Even a good equity mutual fund over 10 years, 20 years has been a multi-bagger. You make multiple 10, 15x returns have been made in diversified equity mutual funds also. Okay. It may not be non-linear, but it could be more linear than a direct stock. Direct equity can be a multi-bagger, but you should be very lucky or highly skilled in having identified it. So, human behavior is such, human nature is such that we talk more about the winners than the losers. So, out of my portfolio of 20 or 30 stocks, I may end up with one or two multi-bagger, which I will be talking about to the rest of the world. I'm not speaking about the 18 or 20 where I have lost money. So if one looks at the entire portfolio rate of return, it would be similar to a mutual fund's rate of return.
I'm so glad you mentioned that because that was my next question. What people often forget to mention is the stocks that are losing and, of course, eroding wealth in so many ways, right? And the risk of direct equity portfolio carries the onus also on the investor of managing that risk, which, if you have a full time job, becomes a tough thing to do. In your experience, Shrikant, how does the risk and potential returns of direct equity compare to mutual funds?
So the very, very skilled investors, of which there are very few in the world, have been able to make wonderful returns, okay, and maybe more than a equity mutual fund rate of return. But are you, as a lay investor, one amongst that rarefied few in the world? You need to ask yourself that question before venturing into direct equity. So direct equity can only be a smaller component of your portfolio if you want to make more consistent returns.
So I
So
think knowledge and time are very, very important attributes of being successful at direct investing. But let's go back down to asking you my next question, Shrikant. I know it's an either or discussion that we began with, but what I want to ask you is, you never feel emotionally attached to a mutual fund, right? With equity, you usually have that sense of belonging or attachment. And I know investing is more behavioral than anything else. So, what I want to ask you is, do you think there is merit in building out a portfolio where there is direct equity and mutual funds? Can they complement each other or are they mutually exclusive? Because at the end of the day, the end product is the same for both, which is a direct equity or a company.
I think they can complement each other. It is not mutually exclusive. Okay, you can have both if you so wish. Because it comes down to saying, uh, based on time and ability, how much. A lot of investors look to buy equities, direct equities, for the excitement quotient. So if you want excitement out of it, then how much of your money are you willing to do for the excitement part? You can go to the horse races, or you go to a casino, or you buy direct equity. I mean, all that is going into the excitement part of it. If you're not there for the excitement part of it, but the wealth creation, wealth, long term wealth building, then you better equip yourself with sufficient knowledge and skill and time. Believe me, it takes a lot of time. If you are going to run through a 100-page annual report, okay, how much time will it take? How many such annual reports are you going to study for how many years? So you see, even if you have to research one company, it takes a lot of time and effort. And while you're in a different full-time job, you'd rather spend your time and energy doing better at your job than trying to do something which somebody else can do for you, which is a professional fund manager.
So focus on what creates active wealth for you, as opposed to what creates passive wealth. But while you that makes complete sense, right? You got to spend so much of time and effort understanding a business, understanding a company, understanding the cycles, and then to add to it, you've got market cycles, market focuses. So there are so many moving parts. But with the number of mutual funds now offered in our country is also enormous. So the process of selection, I would imagine, is as cumbersome, right? Either you spend that time researching a company or researching a fund manager and a fund, in my opinion, would be equally taxing in terms of time, at least.
It takes lesser time to figure out a good mutual fund than a good stock. Okay. So while there are hundreds of schemes in every category that you can choose from, you need to just focus on the longevity of the track record. How long has the fund been in existence? And in that period, has it been at the top quartile of performance? Don't look at flash in the pan performances. Okay. So if you're able to figure out which is a top quartile or above average quartile all the time, it's a good fund. If you do not have the time or the tools to do this, you just simply have to go to a SEBI registered advisor, investment advisor, and they are sufficiently equipped to do all this for you, right? So you can go to your financial planner or advisor. Even with direct equity, okay, you can always go to an advisor. But if you have to do it yourself, then yes. there are a whole lot of challenges up there in front of you. So as an advisor, we look at different methods of choosing funds. Okay, we look at the risk-adjusted returns, okay, or the Sharpe ratio, or the Sortino ratio. Basically, we're looking at, is the risk taken by the fund manager resulting in a sufficient return or not, or for the return given, how much risk have they taken? So obviously, we're looking for the least amount of risk taken to deliver a certain return. That is efficiency. So we are able to figure out which are the more efficient funds and then put them in our shortlist. And then based on risk profile of the investor, we can allocate how much equity, how much debt, sector fund, diversified fund, etc.
Right. So, Shrikant, risk profile is one thing, time horizon is another, right? And this is where I want you to shed some light. Assuming one wants to build a portfolio which is complementary of direct equity and mutual funds, how would you split the time horizon? So, if you want to buy a blue chip, a good quality, for example, a bank, there are only that many things that could go wrong if you're betting on a good quality bank for the long term, for example, right? Uh, if you had to split the asset or the product on a time horizon basis, would you say that maybe one product scores over the other is largely dependent on your horizon of investment?
Yes.
Or that's completely irrelevant? So, you can correct me if that's
There's
not what we
relevance there. There's relevance because longer the time horizon, greater is the ability to implement corrections. How can we be supremely confident that whatever I pick will be correct? So I need time to correct, do course corrections. Okay, so time horizon. And even if there's a market correction in between, we need time for the market to recover. So time horizon certainly is important. Okay. So also within that time horizon, okay, direct equity versus a diversified equity mutual fund. Let us see what has been happening in the last few days. In the last few days, the markets are tending to correct. Okay, and while the market may have fallen 5% or 6% down from its peak, there are many stocks that have fallen 30-40%. Now, were you one of those investors who bought those stocks that fell 30-40% versus the index that fell 5% or the fund that fell 4 to 6%? So the time horizon is important, and within that, the risk profile is also important. If you're willing to take 30-40% loss within the horizon that you have kept for yourself, okay, you're up for buying direct stocks. The criticality matters. Okay. And what
right?
proportion of your wealth have you put into it?
Right. Right. Shrikant, also, while I completely take your point, right? So if it's plain vanilla investing strategies that one is looking at. So, for example, you want to buy a large cap fund or a mid cap fund or a thematic fund, those options are available in the mutual fund universe. But what if you want to bet on a theme like renewable energy? Or you want to bet on the theme like electron EV? Or you want to bet on a very, very small sort of sector. I mean, there are 57 sectors in the market, and not everything is covered in the mutual fund universe. Do you then think there is merit in adding those direct equity stocks onto themes that don't exist in the mutual fund universe?
Yeah, sure, sure. If there is such a theme that one has got conviction and would like to participate in the story of that theme, and in any case, if it's a sunrise industry, it will have a very small exposure of a mutual fund portfolio, and you have greater confidence, then you might as well buy the direct stocks. You need to identify which are all the stocks in that industry sector, and maybe buy the entire basket. Even if the index is not available, you buy all the stocks in that particular sector in whatever proportion you feel like you have a formula for, and then keep weeding out the losers and retaining the winners. Okay, but yeah, it takes time, it takes effort.
So, are there any specific themes, in your opinion, that are currently getting talked about on the street where maybe a fund route is not available, but a direct equity route is available? Have you come across any of those ideas or themes in the current scenario?
uh, Not yet that a theme is available, growing well, but not there in the listed space. Okay,
Okay.
so one finds these things happening, themes available outside India, not inside India. So suppose you want the EV segment, or you want renewable energy or you want nuclear energy, then you don't find those themes inside India. You'll have to go to the global space and buy an ETF of that theme. Okay, you have sectors which are growing like the semiconductor industry in India. Okay? There's not enough happening in the listed space yet. So even then, you just have a couple of stocks to buy and not too many. So the moment the industry is large enough, you'll find enough listed players.
Right.
And
Okay,
you'll
let's
also
now
find them in
talk.
the mutual funds.
You're right. And if I guess a Flexi Cap Fund manager would have the ability to add the latest theme or the latest
Yeah.
trend if it's promising enough or has the potential in that sense. Let's talk about something that often gets overlooked is taxation, cost and fees. So I'm going to start with cost and fees, which are associated with direct equity investing, which includes your brokerage fees, compared with mutual fund expenses. How do both of those score?
So it's like comparing apples with oranges, because when you're paying brokerage, you're only paying for the transaction. Okay, and it could be free, it could be zero, it could be 5 paisa, it could be 10 paisa only to do a transaction. So that could be very less. But when you're investing in a mutual fund and there's an expense ratio of anywhere between 0.25% to 1%, depending on which fund you're choosing, you're paying for transaction plus plus. What is that plus plus? You're paying for professional management, you're paying for liquidity, you're paying for ease of administration. All these you're paying for, which is not included in the brokerage that you're paying. So they're quite different. If you want professional management, if you want the liquidity burden to be shifted to somebody else, if you want simplicity, then you have to pay for all of it. Okay, and the mutual fund will be more expensive, but you're getting your money's worth for it.
How much more expensive would that be, Srikanth? I understand that it comes with professional management and better risk adjusted returns, from a more holistic point of view and objectively. But what would the difference be in cost?
All right. So even if you're paying say 10 or 20 paisa for to a stockbroker, okay, and you go to an active equity fund, actively managed equity fund direct plan, you may have index funds starting from even 10 bips. Okay, as much as you're paying a stockbroker, you can find a passive index fund for the same expense ratio. Okay. If you go to an actively managed one, a direct plan can get you anything from 0.4% to 0.75% onwards. You can get into a mutual fund, actively managed equity fund in a direct plan. So this is the difference. Maybe about the end to end could be about 40 to 50 bips. Okay.
Shrikant, we usually talk about the power of compounding when we tell viewers or investors to stay invested for the long term and to stomach volatility because that is an attribute of the asset class in itself, right? There's no free lunch. What happens then when you're paying costs that are higher in an actively managed mutual fund versus a direct equity brokerage fee? Do you feel like the power of compounding negatively because of the loss of revenue that you're sharing with the distributor could actually impact your returns in the long term, or that is not as significant?
Okay. So direct in a direct plan, there's nothing shared with the distributor. In a regular plan is where a commission is paid, and those expense ratios are much higher. Okay, I was all the while speaking of a direct plan. Okay. Now, if we were to compare the returns from a direct equity portfolio versus an actively managed equity fund portfolio, the first assumption we are making is that the direct equity portfolio is a good one. Is it an amateur who has selected or a professional who has selected? So if it's a lay investor, an amateur who has selected, the possibility of it outperforming the index is lesser. Or it could be random. If you just turned out lucky, like throwing darts, then you may be. But then you're not in the stock market for luck.
Yeah.
You have a goal, you're creating wealth to achieve a particular goal, and you need the money at the end of the period. So if predictability is important, then you want to go for an equity mutual fund, professionally managed mutual fund.
Right. Right. Let's talk about something that often gets overlooked but plays catch up quite significantly is taxation. What are the tax implications of capital gains in direct equity versus mutual funds? And are there any tax efficient strategies that you recommend to your clients that one could consider? Because money saved is money earned.
True. The tax structure on long-term capital gains or short-term capital gains is the same whether you're buying the instrument separately or through a fund. Okay, so in that sense, there's no difference. But if you are trading on your equity portfolio, every time you trade, and if there's a gain, then you have to pay a capital gains tax on it. In a mutual fund, we assume the manager is doing these trades, incurring gains or losses, but the impact of the every trade is not passed on to the unit holder. So in essence, while the churn is happening, the changes are happening in the portfolio, the unit holder is not paying tax till he sells the unit. So in a direct equity portfolio, you're going to be paying tax every year. In a mutual fund, you are deferring the tax. The impact of deferring the tax can show up in your compounding and you make more money.
Also, and also the regulator has clearly pushed investing for the long term, and we've seen that with the launch of the ELSS, which happened many years ago. But nevertheless, worth a mention. Are there any specific tax benefits that one can take advantage of by investing in an ELSS scheme as compared to maybe direct equity?
Yeah, definitely. If you are wanting to take advantage of the ATC provision, then you want to buy the ELSS fund. Buying direct equity will not help you. Okay. But if you're in the new tax regime, there's no place for an ELSS there. Only if you're in the old tax regime and you want to take advantage of ATC, then yes, the ELSS is helpful. Okay. And direct equity will not play a role there for you.
Right. Srikanth, let's talk about this with more sort of actionables, right? And you can keep this swift. In the current market scenario, where it seems that we borrowed returns from the future and the journey from here on will be tough. I think while passive investing so far in the large cap space has outperformed active fund managers, now will be the time when active fund managers will have to show their skill in order to generate alpha. Do you feel like in the current setup, mutual funds, active mutual funds, is a better route to invest in the markets than, say, passive or even direct equity?
At the current juncture, something like a dynamically managed active equity fund would be better. Okay, like a balanced advantage fund, where we all agree that valuations are high, and you would rather have a professional fund manager figuring out the asset allocation between cash and equity or debt and equity. Right? So that is one way. The other debate is active to passive. There are definitely a set of active funds which have been outperforming the index. Okay? I'm not considering factor-based investing here or smart beta funds. That's another category altogether. If you're just looking at a Nifty fund or a Sensex fund, then yes, active funds have been beating it. There have been periods where they did not beat it, between 2018, 20 up to 22 or so. They did not. Again, in the last 1.5 years. So what's happening is there are cycles. There are periods when they may not beat. There are periods when they will beat. But over a longer period of time, you will find that a good active manager will beat the index. Okay, the proportion of good active managers are lesser. So one has to be watchful about that and follow your track record, analyzing track record, etc. Okay, and consistency of performance.
Interesting you say that
Active
because of
fund
the...
management,
Right, sir. Please go on.
active fund managers have a place, and passive managers also have a place, depending on what you're looking for.
Yeah, I think you're right. It's going to be a complementary strategy at a portfolio level. And while I agree with you that balanced dynamic funds could be the way to go because we are expecting a rate cut, but one must also remember that the cost of investing in a balanced fund is much higher. And maybe doing an undertaking asset allocation to portfolio levels in some cases could be beneficial. But I think each to their own. Looking ahead now, we've seen that the broader markets have had a very strong run and a correction is very obviously underway. Do you feel like a portfolio now should be more biased towards large cap funds because the value there is far more significant?
Agree with you. If you're looking at on a relative basis between large and mid and small, it is a large cap which are looking relatively lesser valued than mid and small caps. So yeah, so if you want to be in the equity space, it is better to be in the large cap space at the moment. And if you want to be in a sector which is who has very low valuations, and it is the banking sector in that sense.
Right. Right. What I also want to understand, Shrikant, from you is that everyone's talking about how it's all about sectoral rotation right now. And there are a number of sectors that people are talking about that could be good bets between this Samawat, say, and next Samawat. Capital good company, capital market players, PFSI. Some believe IT and pharma may not do too badly. Do you feel it could be a good time to do thematic funds at this stage, or better off to invest in a flexi cap fund where the fund manager is betting on the next best sector to bet on?
So it all comes down to one's ability to figure out which is the sector that is doing well, or which is going to be the next year's winner. If that ability is there, go choose that particular sector fund. But for the larger part of your portfolio, you should be in a flexi cap, actively managed flexi cap fund. No doubt about it.
Also, you talked about balanced hybrid funds, right? And they, I know, give you do this for you where they rebalance your portfolio depending on where the bias is in the market. But at a personal level or at an individual level, uh, can just holding on to a mutual fund do that rebalancing and diversification for you, or would you have to do that for yourself?
Yeah. So if you want to control the risk in the portfolio, you can do the rebalancing. Okay. So whenever you find that the risk bearing asset has increased in proportion than what you started off with by a large sum, you can have a number, a 20% deviation from your original goal. Suppose you started off with a 60 equity, 40 debt. Okay. And today you're at 90% equity because the market value has shot up so much. You could rebalance, you could sell some of your equity and put them into debt and come back to a 60-40 kind of allocation. Okay.
Right.
This is only to control interim risk. If you were anyway going to leave it for a decade, you don't have to do that rebalancing, in my personal view. Okay, you can just let it be, but you'll have to ride with the waves. The markets up and down will go up. You have to accept it.
Well, we are going into tough times. The market sentiment, of course, very different from what was exactly a year ago. But it is going to be volatile. But equity as an asset class promises to keep you on your toes, but of course, pays you for it by helping you create significant wealth over the long term. Shrikant will take up a few questions at 6:29, so I'm going to quickly go through these. Charmi Patel writes in, and Charmi says, how do additional charges like depository fees, GST, and stamp duty impact overall returns in equity investments? And are there ways to minimize these costs?
Okay, good question. All these costs are so tiny in proportion to the return that you're expecting, they don't matter. Don't focus on it. You're looking for a 13-14% compounding over the next few years. And these costs, which are, a few bips here and there, should not matter.
Would it be fair for me to ask you what is the percentage of these costs that usually go in as hidden charges? Just so that we know. I mean, I know it's not significant, but just so that we're aware.
So thankfully, when you're going through a mutual fund, there are no hidden charges. All the charges that are expected to happen are bundled into the expense ratio. So you don't have anything beyond that. Everything is very transparent to you. There are no shocks.
Right.
Okay.
Right.
So when you're buying stocks, yeah, you have your
right.
GST.
I have another question that comes from Nidhi, and she says, what are the typical fees and charges an investor should be aware of when trading equities in India, such as brokerage fees, short-term tax, and other transaction charges?
Okay, so I think some of these you had answered yourself in the
Yes.
in the previous set. You have your STT, you have your GST, you have your depository charges, okay, and of course the brokerage that you have to pay. Okay, apart from that, no,
Shrikant,
there's nothing
to
else.
compound that, do you think it'd be about under 0.5%, 0.5%, not more than that?
Yeah, that's about it. Less than that.
Less than that. Okay, so it's under
Yeah,
0.5 in terms
yeah,
of all the cost that you
yeah.
would load up.
If you're buying stocks separately,
Yeah.
okay,
And mutual funds,
it could go up to 0.75%. It could go up to 1%
0.75%.
expense ratio. Okay, all
Right.
in.
Right. We also have one last question from Ashish
If you want
Thakur.
to
He
minimize
says,
it,
yes,
just sorry to
yes,
interrupt.
please.
If you want to minimize it, okay, then you should buy a direct plan.
But then you need
where
an
you are
advisor to
eliminating.
advise you on it, right?
Yeah, you have do-it-yourself platforms. Okay,
So I think the
and if
better
you
way to
have
do
the
this is, yeah,
ability,
work with an
advisors.
advisor who charges you a fee, and then you can of course do it on the direct code, but you pay for the fees anyway. So like I said, there's no
Right.
free lunch. Well, then we've got one more question from Ashish Thakur, and Ashish says, "What is the return one can expect from equity mutual funds? Is this the best of the market, and is the best of the market rally behind us?" I think this is a very tough question, but please go ahead.
Okay. So we have seen an unusual rally over the last 2 years, and there's no two ways about it. After such a rally, and then we see that at this point of time, valuations are way above the average of the last decade, then we know that the next period would not be so good. Your expectation has to come down. So yes, the I do think the best part of the recent rally is behind us. Okay, and now we may either have a time correction or a price correction. I don't know which would happen, but one should keep our expectations tempered. What should one expect in the long term? I think the consensus is that if one can get a 13% kind of compounding from equity over the long term, it's good. Okay, you're still making a 6-7% real rate of return at least, which is excellent.
Right. So you've got to be mindful of the fact that we're going into a time when the markets could be very volatile. We have borrowed returns from the future. The last 9 calendar years have actually seen the markets end on a positive note. So be careful, be mindful. But the fact remains that over the long term, India still is in a structural bull run, and any structural bull run is made up of many mini cycles. So you've got to be careful about that. And profit taking is healthy because it gives you more opportunity to come back into the markets and allocate incremental capital. But Shrikant, great talking to you. Happy Diwali to you and yours, and we'll hopefully see you soon.
Thank you so much. Happy Diwali.
Thank you.